If you think interest rates are confusing right now, you are not alone. Between global conflicts, central banks changing their policies, the rise of AI is going faster than anybody could think. Today, I'm joined by Christine Tan from Sun Life. She's an economist who's regularly been on BNN as well as the Globe and Mail. And we talk about four kind of key things that you need to think about. This is a longer episode than usual, but I think it's absolutely worth to listen. We talk about why the Bank of Canada and the Federal Reserve are no longer moving in sync, how global conflict is quietly pushing mortgage rates higher, why AI may reshape the market in ways that none of us could expect. And finally, we wrap up with a concept called multipolarity, which I didn't know what this meant. This is a new concept to me, but how it's going to affect the global economies over the next several years. And so it's a fantastic conversation. A couple quick things about Christine. So she's with a company called Sun Life, and Sun Life just came in the mortgage industry a few years ago with a really cool tool called Prosper. And it basically connects mortgage brokers to financial planners that work at Sun Life. And so there's creditor insurance that's available to all mortgage brokers. And most of the time, when somebody looks at creditor insurance versus getting a separate policy, often the separate policies are better, like not always, but a lot of times. And Prosper allows you to connect with a financial advisor. And so they've got a really good program. Check them out. If you're on Finmo, they're literally on there. Check out Prosper and check out this conversation with Christine. Hey, Christine, welcome to the show.
Hey, Scott. Thanks for having me.
So, today I'm very interested to chat with you, or excited to chat with you about a couple different themes that in particular are going to be interest to our mortgage broker listeners. But before we do, maybe just tell me a little bit about yourself and how you got into what you do.
Oh, my goodness. I'm going to say I started in this industry very, very young because it was in the 90s that I started in this career. Grew up in Asia, always loved the markets, always loved economies. My father was a financial advisor before he fully retired. So I think that's where I got that interest from. And I've done a series of different things. I started out in mergers and acquisitions. That was my first job on Bay Street. And then I've been on the buy side or in asset management since 2001. So
Okay.
It's been quite an adventure, but a lot of learning along the way.
Right. And so there's, as an economist, so what I'd love to ask you about, like the Federal Reserve continue to cut. So if the Federal Reserve continues to cut, how's that going to, and a Bank of Canada doesn't, what is that going to mean for us in Canada? Because again, most of our listeners, 80% of them are Canadian. So
yeah, that's right. No, it's a great question, Scott. So, the Bank of Canada certainly was quite aggressive is not the right word, but they were continuing to cut throughout the entirety of 2025, whereas the Federal Reserve in the U.S. did go on hold after cutting in the first part of the year, and then they did one last cut before year end. And that was because in the U.S., inflation was still farther away from the 2% target than it was here in Canada. And I think it's also fair to say that the tariffs that President Trump had sort of put into place was a potential inflation risk to the U.S. So that's why their central bank said, you know what, let's not be too aggressive in cutting interest rates in case inflation starts picking up again. And then on the other hand, for us, tariffs was actually a negative impact on our growth. So in a way, the Bank of Canada was more focused on, okay, well, inflation's close back to our target, and we are now worried about economic growth, especially in some of these sectors that are directly impacted by tariffs. So because of that, there is that divergence. So now,
it's acting. Sorry to interrupt. It's acting like a brake on the economy, effectively.
Yes,
in Canada,
right.
The tariffs are acting like a brake for us. Correct?
Exactly. Okay.
Okay.
Especially when you're thinking of like South Ontario, where you have a lot of manufacturing, whether it's steel or autos. Those are some of the sectors that are definitely quite adversely impacted by tariffs. So what does it mean if the Fed's continuing to cut this year versus the Bank of Canada? Well, it does have implications for the US dollar. So if the Fed is cutting while the Bank of Canada stays put, then on the margin, the US dollar would weaken, all else being equal. Now, obviously, we're having this conversation almost 4 weeks into the Iran war. So it's fair to say that the inflation picture is very different today. So just to give you a sense, Scott, of how the bond market is moving very, very quickly, on March 27th, or February 27th, which was the day before the first attack, the bond market was pricing in 2 cuts from the U.S. Federal Reserve. And then at a certain point last week, when there was a lot of concern around how long this war would last and how closed the Strait of Hormuz was, because keep in mind, 20% of the world's oil goes to the Strait of Hormuz, and 15% of the world's fertilizer goes through that port as well.
Mm.
So there are implications for food prices. So at the worst levels, the bond market actually only priced in the first cut from the US in the third quarter of next year.
Right.
Today, it's back to pricing in like one cut by the end of this year, possibly early next year. So very much a different picture than where we would have been even 4 or 5 weeks ago. But on the margin, if the Fed continues to cut in the US while the Bank of Canada stays put, there are implications for currency. So Canadian dollar should be stronger than the US dollar.
If the Federal Reserve cuts more, will the Bank of Canada be forced to cut, or will we just you don't think it's not going to, because often, I mean, we're like the big ship that moves us a little. That's been my experience. But in this case, it wouldn't necessarily mean that we're going to follow them.
No, not at all. I think if anything, there was a couple of points last year when the Bank of Canada was actually asked if they would continue to cut if the Federal Reserve was staying put, because there's always that sort of interest rate divergence. And historically, there's usually a bit of a range that US interest rates and Canadian interest rates tend to stay quite lockstep, which is the point of your question. So because the Bank of Canada was quicker to cut last year, in a way, you can think of the Federal Reserve as to some extent catching up on cutting this year. So it's unlikely that Macklem and the Bank of Canada will cut. Now, having said that, there are fundamental weaknesses in our economy. So that is something that Governor Macklem has flagged several times in the most recent announcements of interest rate decisions, i.e. even when they say they're holding rates, what he'll do is he'll talk about what he's looking at. And he acknowledges that the labor market, for example, is quite weak. But what he's also said is that at this point, because all of the job losses are in sectors that are impacted by tariffs, these are not economic conditions that can be solved by lower interest rates. So you actually need fiscal policy. So looking at some of these policies that the Carney administration or the Carney government is looking to implement, whether it's, kind of trying to build up a defense industry in Canada, spending more on defense and sourcing more of that domestically, partnering with global automakers to bring jobs back to Canada. That's what the Bank of Canada is referencing, which is a fair point, because if tariffs are why auto companies or factories are actually furloughing Canadians, and if tariffs are why Algoma Steel is temporarily closing one of their plants, lowering the interest rate actually doesn't change anything because it's a demand issue. And that's why the Bank of Canada has said at this point, it's not clear that we can do anything. It needs to be the government.
Right. That is actually not going to help what this particular, it's not the right treatment for what the disease that we currently have.
Correct. 100%.
Okay. So do you think then, what do you, let's say, again, things can change so quickly, but given what's happening right now, do you see that fixed rates are going to continue, the bond market's going to continue to go up? And what would have to happen for it to either slow down or, stall?
And that is the crux of it, Scott. You've identified the key point, because a lot of times we focus on what the Bank of Canada does, which is the overnight rate, but none of us borrow at the overnight rate. Mortgage rates are a reference off of the 5-year bond yield or the 10-year bond yield. And that's actually been creeping up because of concerns around the impact of the Iran war on inflation in the longer term. So what happens to the bond yields? I'm looking at the 5-year, for example. Back in February 27th, right? The day before, it was 2.6%. That's the 5-year bond yield. Today it's at 3.1. That's all because of what's happening in Iran. So fundamentally, what would it take for bond yields to come back down? It's a resolution. I wouldn't even say a ceasefire, because a ceasefire might cause bond yields to come down a little bit temporarily. But I think what the bond market's going to look for is a more clear picture that there's a fundamental change, like whether it's a permanent peace or some kind of plan whereby it goes beyond just a short-term ceasefire is really what we need to see for bond markets to settle back down.
Right. And have you seen, again, this is going to be time-stamped and depending on when this episode goes out, but I don't know, you never know what you see online is real, and I don't always fact-check it, but I did see some posts somewhere that Trump was saying that he figures that they're done now, that they've done what have you seen that? Is that the case? And is that, if that's the case, if that's true, if they do, what's going to happen from that?
Yeah, so as of March 25th, certainly we have heard the same. There was a White House press conference this morning, and we heard similar messages around how there are talks ongoing. The US has sent a 15-point plan to the Iranian government via an intermediary as to what it would take for them to sort of cease attacks. It's complicated to try to understand where the off ramp could be. You do have essentially three different parties with slightly different objectives in mind. You've got Israel, who's fundamentally in the region, so they are much more involved in the longer term stability or lack thereof. And then you've got the US and then Iran. So, do we believe that there are talks ongoing? Yes, there is. You have to take the president at his word that there is a plan that's been submitted. How long it would take to come to a permanent resolution of some sort, it depends, because we did have talks that were ongoing since, to some extent, June of last year with the first attacks. So it is a very complex and fluid situation. But certainly, we hope for everyone involved, especially the people of Iran and the people of Israel and also the surrounding region, that we do come to a resolution. And the
Right.
key is that until it does, you're going to continue to see concerns around inflation. Because the other thing I would sort of highlight is that some very, very smart strategists that cover the agricultural sector, for example, this is planting season, right? And right now, with the disruption in the fertilizer supply chain, farmers are already seeing higher costs to fertilizer inputs.
Mm.
So, regardless of whether it gets resolved today or next week, to some extent, you will likely see an impact on food prices a few months from now during harvest time. So, the Strait of Hormuz is a very important thoroughway for a lot of key inputs for the world. And that's why you're seeing such a notable response in the bond market, in currencies, as well as inflation expectations.
Okay, really good. Thank you for that. What I'd like to switch gears to now is AI.
Yes.
And what do you think the impact is going to be on a market as well as an economic perspective?
AI, I think you and I chatted briefly on how we both are fascinated by the opportunities and the potential of AI. As an investor, what you've seen is over the last 3.5 years, an evolution of the AI story. So it started with when ChatGPT first emerged into our consciousness. We as in the financial industry were focused on the enablers. So think the picks and shovels, the builders of capacity or AI generative capacity. So the NVIDIAs of the world, the Magnificent Seven, for example, that was the initial focus. What we started seeing last year, though, is that we're now looking beyond just the who's building the capacity to who's using AI, how are they using it, and is it generating an incremental return for that
Mm.
business? Now, one of the lowest hanging fruit, if you will, for the implementation of AI is cost savings from a headcount reduction, right? Like if you're
Mm.
enhancing the productivity of your team, you don't need as many people to do what you used to do. So that's kind of the
Hmm.
first generation of return on investment, if you will. But now it's beyond that. So we're looking at companies on, are they using AI to be able to engage with their customers in a more meaningful way? Does that
Hmm.
result in selling more products to the customer, a deeper relationship? Does that increase the return of that same customer because they feel like, this business really understands what I need and I want to continue working with them? So that's kind of where we are at the AI. I would say AI in North America. Now, there's also AI in China, which is kind of moving down a slightly different path. So if I had to differentiate the two, AI in North America is still focused on generative capability. So how complex of a model can we build? And that's why you see NVIDIA every year coming out with a newer generation of GPU chips that actually can do more and more with the same infrastructure.
Hmm.
China is developing AI more from a use case perspective. So everything they're doing is the so what? How can we use this to build better robots? How can we use this to improve security and things like that? So it's a slightly different path. Obviously, The underlying architecture is the same in terms of what you're trying to build, but the ultimate goal is different. US, North America, we're focused on the most complex models. China is focused on use case.
Can you give me an example of something that they're doing that you know of that they're doing in China with this different focus? Just to dumb it down for me and my listeners. Tell me like I'm 10.
So, for example, using AI in sort of analyzing weather and agricultural patterns as to better sort of forecast how to enhance yield. That's a very, very simple application. And again, it sounds like it's pretty straightforward, but the difference is in North America, the model and capability would be there, but then you would actually need someone, whether it's a farmer or a company like, say, Deere, to actually go and utilize that model. Whereas in China, because it's sort of a more of a centralized approach to development, there is a directive to say, okay, so how else can we implement AI at a country and economy level? And this is one way where we can apply it to enhance yield, to basically maybe grow crops in a much more water efficient way. So that's one example of how you have one that's more theoretically based and where the users.
Yeah, it's like they're racing to see who can get to artificial general intelligence the quickest.
Exactly.
And then we have Skynet and Terminator. I don't know. I'm just kidding.
I know. Hopefully I was just watching a TV series called Next. It was about, again, an AI that becomes not quite sentient, but smart enough to know that they were about to be shut down. And so figured out how to ship itself to a different location and basically avoid being shut down.
Right.
It's a fascinating TV series.
It's very interesting. Yeah. Okay. So, and then what do you think, what kind of impact will it have on the mortgage business specifically? So what are your thoughts on the impact of AI as a mortgage broker or on that side or the lending side?
So, as someone, this is just from a peripheral level, I would welcome your thoughts as well as someone who's actually very deep into the industry. But the way I can see it kind of being applied is, first of all, data analytics, right? So really using AI to be granular in understanding the local market dynamics of what's happening, whether it's putting together employment data, income growth data, but also forecasting. That's the important thing. So right now, StatsCan provides very granular jobs data. So I can actually drill down to individual cities and unemployment rates in Kitchener-Waterloo versus Quebec City, right? But you could theoretically, I haven't done it, but I'm sure someone somewhere is doing it. You could take that historical data, combine it with, let's say, policies that the government's announcing around increased defense spending. What does that mean for growth in Trenton? Because, the biggest Air Force base is in Trenton. Right. Trenton's not a big market. So imagine if all of a sudden you start spending more and you get more troop deployment. What does that mean for demand for housing in a pretty small, tightly controlled market? So that's kind of how I can see it, analyzing a lot of data and kind of applying that forecast by implementing or including some government policy directives. Recognizing that there's always going to be a scenario base. You're not going to be able to predict with 100% accuracy, but at least it gives you a sense of if Canada achieves their defense spending budget by X, what does that mean for demand for housing?
Right. What an interesting idea to even just to suggest take that historical data along with policy and then map out some what if scenarios of, obviously it can't see the future, but it can give you insights that you wouldn't be able, like how would you parse all that data as a human? Like it'll be so much work. Right.
Exactly. That's exactly it. So historically, you would have done things like, if there's a major highway that's being built, then whatever communities it's connecting, we know the value should improve because now it's connected to a major highway. But that is arguably a little bit more easy to analyze because these are slow moving projects and very visible. But with something like policy, like let's say if, we have an RFP out to purchase submarines and the two final bidders are ThyssenKrupp from Germany and Hanwha Group from Korea. So Hanwha has already said, if we win, we're going to provide more than $200 million to Algoma Steel, for example, to bring one of their plants back online, and we're going to use the steel from that plant. So if you had a model that then analyzed, okay, if we go down that path, what does that mean for employment surrounding that factory, that facility? And what does that mean for the longer term housing demand, and is there a mismatch in supply and demand? Because it's
Right.
going to be a multi-year project to build those submarines, as well as to build the ports that the submarines are going to come into, and also to continue to maintain and refurbish those submarines. So that's where I kind of see AI giving you a very granular picture, but overlaying it with different scenarios as to how different cities would grow. Or let's say Churchill in northern Manitoba. We have a port there. Historically, we never really focused on developing that port, but given what's happening with tariffs, there's a lot of talk of doubling the throughput. And Churchill is a very, very small town, right?
Right.
That would be a huge economic implication if you were to really enhance or develop that port in order to ship more to Europe. So that's how I can see on the projection side. The other side would be using AI to better analyze data on your clients. So maybe if there was a way to really do group analysis of different profiles of clients, such that when you meet a client, or whether it's a single buyer or couple buyer, or you could then use that profile, put it into a model and say, based on these characteristics, based on all the data that we've had from this big group of analytics, what are they most likely to do? So that's kind of more consumer behavior, which a lot of
Right.
consumer goods companies are using. But I can see how that could be applied to
Hmm.
house buyers as well. And then I'm sure the banks are also utilizing AI in some more complex models to also assess risk of
Right. Yeah.
mortgages.
Fraud and other things to catch things that would be whenever you got mountains of data, how do you go through it? I could
Exactly.
see someday CRA is just going to be an auditing machine. They're just going to use software that'll
Absolutely.
like there's no world as I just think of this is terrifying.
I
They're going to
know.
be able to use AI to basically find every nickel because that's if that's not already being done, they for sure they're looking at it. And
What would you say? How would you see AI, like being someone who's
well, I
in
mean,
the
I'm more
industry?
on the street, like so. It's interesting because your perspective is always at like a much higher level.
Macro
You're
level,
looking,
yeah.
yeah, macro, and I'm on the micro level. Like, what's going to make my job easier? And so,
Mm,
any tasks that require data or in analyzing data will be, people will start leaning into AI more, and you're already seeing it.
yes.
There are companies that do down payment. So there's lenders that'll do down payment loans 12 months, but you got to go through all the bank statements. You got to make sure there's nothing weird in there. It can take a lot of time in a big business. I would hate to go through 12 months of our bank statements. It's enormous. But they're using AI now to help find, track down, down payment money and so all this stuff can really make a big difference. So I feel like those are the
Interesting.
tools that they'll increase efficiency. And I think that increased efficiency will mean that I predict that we'll have potentially fewer brokers being more productive, like in any professional services business. And I saw something recently from, I think it was from Harvard, like a lot of, they're not hiring the junior people like they were. And maybe we could talk about that next. It's because this senior person can get more done with a bunch of AI tools and rather than bringing in the junior person. So maybe that's a good segue into the 25 and under employment, what you're
Yes.
seeing there.
That is, if I had to flag sort of a near term concern from an economic perspective, it would be the implications on employment. So at the aggregate level, Canada's unemployment rate as of February is 6.7%, but the unemployment rate of the under 24s, because Stats can sort of aggregates it by age group, it's actually just over 14%. Now, part of it is normal when the economy slows down that the unemployment rate of the youngest cohort picks up. Because if you're a company or a business and you're worried about your outlook, the first thing you do is, I'm going to hire fewer new people. And that's why the
Hmm.
first time job hunters are going to suffer the most. The bigger question is how much of that is permanent because of AI, right? To your
Right.
point, like I've been in industry for 20 something years. I essentially use AI as what I call my junior analyst. Like it's doing for
Right.
me work that I used to have a full-time analyst aggregating data and information and research for me. Now I'm using AI. So I think there is a point where part of that lower employment level for the youth is potentially more extended. And even if the economy recover, we might not see the same snapback. Now, what my concern though is that you still do need to build a pipeline. Like I'm hoping I don't work forever. Like at some point I will retire,
Yeah.
even though I know that, we all love our jobs and our work long past when my grandparents retired. But you need to build a pipeline, right? Like the whole point of those first time jobs is that's where you're learning the basics. You're making the mistakes. You're observing what your bosses do, some of the soft skills. And if we're just relying on enhancing the productivity of people who are already in the industry, at some point, 10 years out, 15 years out, there's going to be a broken rung in the ladder where you haven't built the pipeline of talent. So that's kind of, again, we're only in sort of the beginning of year 4 for this burst in utilization of AI, right? So it's still early, but that's something that needs to be considered when it comes to policy. How are we going to be intentional in terms of engaging the youth? And the reason why it's important, well, first of all, for the housing market, first-time home buyers, right? Like you need that natural pass on of assets, if you will. As someone retires, they sell the home to the next generation. As someone downsizes, once their kids leave, again, you sell it to the first-time home buyer. And increasingly, you see this more than I do. The first-time home buyers just stretched. Like affordability is not there. And now if you add on a challenging employment market, that's an issue. So,
yeah, for sure. And the average age of a first time buyer has gone way up too.
yeah,
Like it's significantly higher than it used to be. And I think that's probably definitely one of the factors. The other thing I see, I mean, I'm not an economist or anything, and I'm a pretty simple guy, but I don't think that there's any scenario where it's really good to have a large group of people unemployed and disaffected
exactly.
I've always thought if the game doesn't feel like they can win, they're not going to want to play. And I feel like the young people today have kind of got a bad deal in that it's going to look like a game they don't want to play. And if they don't want to play the game that we've all been playing all these years, if you get the wrong people in power, like they burn society to the ground. Not saying that would, but if you look back over history, that has happened. If you get a
Agreed.
large group of disaffected people, they will go, we're going to fix things. And that usually leads to a lot more pain and chaos. And so I think we have an obligation to them as well as make sure that it's still a winnable game for them. Otherwise, the whole thing is going to collapse. But I don't have the solution to that.
I absolutely agree. My godson is 22, or one of my godsons, the oldest one is 22. He's graduating this year. And when I look at when he was even just 10 years ago or 5 years ago, he was big ambitions, had big goals. And now when you ask him what he wants, he's like, because he does feel like, it's very hard to find that job that he wants. He's not even looking for his dream job. So to your point, and this is someone who studied hard his entire life. He has top grades, not to say grades are everything, right? But he's never been afraid of hard work, but he feels like the odds are stacked against him.
Right.
And there is a certain level of malaise because it's almost like managing your own expectations. Like you said, if you don't think you're going to win at the game, you want to manage. And that's never.
Yeah, exactly. You can't get excited about it. Like I know that I was fortunate being when I was born. Like there's Warren Buffett talks about winning the ovarian lottery. It's kind of a crass way to say. And I remember listening to him talk in his book. He was saying how if he was because of where he was born and his personality and temperament, he was able to become very wealthy. But you put him in another country where those opportunities didn't exist, and he could be a shoemaker. Nothing wrong with shoemakers, but like. The reality is that there is a bit of luck involved in this whole thing.
100%, 100%. Because you see, when I was an emerging market manager, I would travel to all the countries that we're invested in and meet with management teams of the companies. And along the way, I would just meet people outside of, because I like to do due diligence to understand the society. And you meet just young people in emerging Asia and you think, wow, this person is so entrepreneurial. Just to make a little bit. And if you took that entrepreneurial spirit, put that person in a better circumstance where they had more opportunities, they would absolutely be, I don't even know what the limitations are.
Yeah, they would crush it. Yeah, it would be out. Yeah, I'd say that's an interesting way to think of it. Now, last thing I want to ask about something that we had chatted about before we got on this podcast before, but what is multipolarity? Like, what I don't even know. Like, and again, tell me like I'm 10. Assume the mortgage. Like, I need to dumb it right down for me so that I can. And what is that going to affect? Like how that affects interest rates and trade and stuff.
So, multipolarity is it's an interesting topic that used to be more confined to, I would call it academia and maybe like the World Bank or like the IMF, like very, very big global institutions who just kind of get a bunch of PhDs together and talk about things, right? So it never really found its way into everyday lexicon. So you're not the only ones. And if I didn't do what I do for a living, I wouldn't know about multipolarity. But essentially it's the concept that we used to live in a world where there's always a leading economy and then everyone else is pretty far behind. So whether it's the British Empire or the Roman Empire, or it's been the US as the leading economy for the last, really since World War II. So we're used to that world. And in that world, regardless of who the leading economy is, there are usually a set of rules that everyone sort of agrees to abide by. And it's often rules that are set by that leading economy. And there's just like now, the US dollar is the reserve currency. There's also an agreed upon form of trade. Like, if all else fails, I can trust that if I trade with you in US dollars, that's safe. I might not want to trade with you in your currency, or you might not want to accept my currency. Its multipolarity started to emerge. So that was sort of unipolar, if you think of it that way. One pole, everyone else sort of falls behind it. And then, of course, over the last 2 decades, you've started emergence more of a bipolar between the US and China. Now, in a way, there hasn't been really direct conflict because they're geographically on opposite sides of the earth, right? So each country, we have their own sphere of influence. The US is the Americas. China kind of has the Asia country. And then you've got Europe in between that kind of does trade with one and is geopolitically aligned with the other. But then what happened over the last 15 years is that the small emerging countries became bigger. So countries like India, like Indonesia, which has 600 million people, India has 1.5 billion people, they started growing big enough that they had a domestic consumer base. So they were no longer just countries that were servicing or providing services or goods to the rich countries. They now were doing things for their own people. And what that meant was they became less vulnerable to what happens in the US. So it used to be that if the US goes into a slight recession, the rest of the world goes into a terrible recession.
Everybody, yes. Okay, that makes sense.
It's that whole I sneeze and you catch a really bad flu thing, right?
Yeah.
So this kind of more emergence of different economies and domestically driven economies gave rise to more poles or more resilience. And then what happened is, with the introduction of global tariffs last year, and keep in mind, up until the tariffs, the US is still the single biggest consumer in the world, by far. So what the tariffs gave rise to is all these countries that still sell a lot to the US started realizing that, okay, we need to spend some time thinking about our own resilience in a more intentional way. So rather than just getting more resilient just because our people got richer and started spending more on goods, we need to think about what kind of manufacturing base we want domestically, what infrastructure do we want, and then because of and I'll speak about Canada specifically, because now we're worried about some of the breakdown's not the right word, but I'll call it erosion of traditional alliances. There is more of we need to be more self-sufficient in defense, right? Because Canada has always been part of NORAD. We've always been an implicit and explicit part of the US defense infrastructure. But now if there's a concern potentially that the US might think of us in a more annexation kind of mindset, then we do need to think about things like that. So now you're giving rise to this multipolarity where there are different groups or middle powers, as Carney calls them, that's trying to think more about, well, let's work together. Scott, you and I, we're kind of at the same level, instead of us both trying to cater to a much larger entity, which we still will. We'll still trade with a big entity. But let's you and I do more together. And so that's the emergence of the multipolarity. So what does that really mean for Canadians as investors and for interest rates? It means that there's no longer as clear a set of rules.
Right.
Whether it's military rules of engagement or rules of trade or alliances. So what happens then when there's uncertainty like that is you start seeing risk premium being priced into a lot of different assets. So whether it's bonds or equities, you start realizing that there can be more uncertainty. You could see, we did have the IEPA, the International Economic Emergency Powers Act. Those tariffs were just overturned by the Supreme Court. But immediately, the Trump administration put on Section 122 tariffs because they
Right.
believe in tariffs. They're going to get tariffs, whatever path they achieve, right? So all of that to mean that we've just come through this perfect storm, perfect environment of where you had a very clear set of rules, trade, alliances, etc., for 20 years. You had a very stable global economy. And so companies were able to grow easily. So if you're an American company, you could grow in
Yeah, you
China
can
very
invest for the
easily.
long term because right
Exactly.
now it's very uncertain right now.
Exactly. So if you're the CEO and you're trying to decide, I need to build another plant, but where do I build it? Do I build in the US? Do I build in Mexico? Do I build in China? Do I build in Vietnam? Of course, the answer will depend on who you're making goods for. So you probably want to be closer to your end customer to reduce the risk.
Right.
So that's what multipolarity is. It's just this emergence of more centers of influence. And some of it is by geography. Some of it is through what we call shared beliefs and shared cultural norms. So, for example, Canada, we're far away from New Zealand and Australia. But as Carney says, Australia is basically like our cousin. We're almost identical type economies and countries. Big landmass, small population, a lot of resources. And our main export is resources. So we are the same country, just on different parts of the world. So in that case, we're tightening that relationship, not because of proximity, but because of shared economic outcomes.
Right.
And all of
Okay.
that is multipolarity.
That makes sense. And okay, that's very good. So, is there anything that I didn't ask you that you think our listeners would find useful? If I'm a mortgage broker listening to this, so we talked a couple of things that we talked about. We talked about the idea of the Federal Reserve and Bank of Canada not being
Yes.
in sync, and how that it's likely not going to be in sync in the short, at least in the near term. We talked about AI perspective from at least the top level, how it can be used, and then this under 24 cohort of folks that are not highly employed, and then multipolarity being sort of a solution that is new. Because you're right, if you think back over history, there was like the Persians, and then there would be always one dominant power
Correct.
that everybody used their coins. They set the rules. They set the cultural rules. And that does not seem to be as it's definitely not. It's more fragmented now for sure. And
I think if there was a key takeaway to kind of weave that all together, volatility and uncertainty is now a feature of the system, not a bug anymore. And that's coming out of all of this, right? And for your listener base, I guess anything that impacts the average consumer or the average Canadian is what impacts their business, because it's the ability to purchase a home. And everything that we've talked about does impact the Canadian consumer or the Canadian home buyer, whether it's through interest rates, so transmission of the uncertainty that we're seeing globally into, is this inflationary, which then causes interest rates to go up, which then causes mortgage rates to go up. AI impacting employment, especially for the first-time home buyers, that's a big issue, right? Because even for existing home buyers, if I wanted to downsize and there's no one behind me who's going to be able to afford a home, there's that trickle-down effect as well. And I think, ultimately, what we've been seeing in the last several months is, in a way, it's good, but we're watching very carefully to see where debt levels go. Governments are becoming much more involved in the economy, right? And they're having to be. So if you look at the Canadian government, for example, whether it's defense spending, whether it's planning, like trying to improve housing affordability, it's like getting directly involved in trying to build up a defense industry, which we used to have before we decided to highly link ourselves to the US defense industry. So this is, which is both good and bad. In some ways, I would contend that certain things require government policy to push it through. But if implemented the wrong way, it could end up just being more inefficient.
Right.
Because we always need that blend of private capital tends to be the most efficient because it's ultimately profit seeking, and we'll try to get there the fastest and the most cost efficient way. but we do need the policy in place that will allow things like that to happen. And, at the back of it all, we are spending more, which means more deficits. Deficits have gone up around the world. And it's coming at a point when government debt levels are already quite high. So
Right.
what does that mean for interest rates longer term? And what does that mean for economic growth? Because essentially, you are kind of borrowing a little bit from future growth when you're stimulating the economy and taking on incremental debt. So,
Right.
Volatility, uncertainty, features of the new system, unfortunately, because of multipolarity, but very much watching and kind of, I'm trying to look at it glass half full. I'm looking at some of the policies that this government is trying to implement and hoping that, it will create some new jobs and new industries.
Right.
But it's not an
Yeah.
easy job. I don't envy their
Oh,
job.
I know. I don't envy them either. I don't know. Like, I'm sure that it is incredibly complex, and every decision has a ripple effect, the unintended consequences, unintended, different groups that get affected by it. So I can imagine it would be very difficult. Well, Christine, thank you so much for chatting with me. I really appreciate it. And I hope
Thank
our
you.
listeners got a good idea of just some things to keep an eye out for. I feel smart. I feel like my IQ has gone up a little bit, but it'll drop back down to its normal level
Oh,
very
that's too kind.
quickly.
Thank you.
Thanks, Christine.
Thanks, Scott.
Hey, thanks again for listening. I know that was a longer episode than usual. I've been doing some of these interview shows a little bit longer because I've been enjoying the conversation. Hopefully you are enjoying them as well, and you got some ideas from this conversation with Christine. The market is absolutely changing. I still believe we have a massive opportunity as mortgage brokers. There's going to be a shift in the industry. People are going to move towards, and I recorded a podcast on this recently, but the idea that we're going to see more commission compression as consumers become more educated, but we're also going to see highly productive mortgage brokers who are crushing a number of mortgages that at one time would have thought would be impossible because of the use of these tools. And so there's going to be opportunity for people. Just you get to decide what side of the fence you're on. As I always say, there's no problem in your mortgage business someone else hasn't already solved. Your problem is finding the answer when you need it. This podcast is designed to provide some of those answers. Thanks for listening, and I will see you on the next episode.